We all love talking about the weather, don't we? Right now, the big debate in investment is to what extent investors should be wearing the financial equivalent of snow boots and puffer jackets. I'm talking about bonds. They're the main asset class we keep coming back to in this series. Bonds are tradable loans issued by governments and companies. Traditionally, they've been viewed as a defensive investment, certainly compared to more racy shares. They're good things to hold alongside shares in your ISA and pension. The trouble is, the outlook for bonds is very cloudy at the moment. There could be trouble ahead. Bonds' reputation for safety is based on the fact that most pay a fixed rate of interest. This is unlike shares, which might pay you a dividend or might not. As a result, you kind of know where you are with bonds, right? Wrong. Many experts fear that bond prices have become dangerously high. They fear that the ground on which bond investors walk is icy, that unwary investors might take a nasty tumble. To understand why experts are concerned, you have to know what makes bond prices move. Two main factors affect bonds. The first is interest rates, and connected to that, the level of inflation. Right now, interest rates are at an all-time low, but at some point they'll have to rise. Rising interest rates are bad for bond prices because it makes the fixed rate of return from bonds look less attractive. Fewer people buy them, so their price drops. Bonds also hate inflation because it erodes the value of their fixed returns over time. Rising inflation hits bond prices because it means central banks will have to raise interest rates in order to stop their economies overheating. Experts worry we could face an inflation shock in the future. This is because all the hundreds of billions of dollars and pounds that the US Federal Reserve and the Bank of England have created in recent years to avoid us falling into a depression could be building up inflation in the global economy, and that would be bad news for bonds. The second big factor affecting bond prices is the credit rating of the company or country behind the bond. If the bond issuer is financially strong and has a good rating, it will pay a lower rate of interest. If the bond issuer is financially weak and has a low rating, it will have to pay a higher rate of interest on its bonds. Historically, the government bonds from mature, developed economies like the UK, US or Germany were seen as rock solid. With a AAA credit rating, these government bonds could pay a low amount of interest. Below them were corporate bonds from big companies. Although still investment grade, they did carry a slightly higher risk and so had to pay a higher rate of interest or spread above the rate paid by government bonds. Below them were the bonds from struggling or financially weak companies. Deemed to be non-investment grade, they had to pay an even higher rate of interest. That's why they're also known as high yield or junk bonds. Last of all, there are also the bonds from emerging market countries. They were also deemed to be risky, and so they too had to pay a higher rate of interest. The financial crisis has changed all this. The big budget deficits of the UK and the US mean their government bonds are no longer as attractive as they used to be. The US lost its AAA credit rating 2 years ago, and the UK could lose its top rating this year. Nowadays, most investors prefer corporate bonds, high-yield bonds and emerging market bonds. This is because many big businesses and many of the countries we used to dismiss as emerging are in fact in financially better shape than the debt-laden economies of the West. So, is there a bubble in bonds? Yes, there certainly is in UK government bonds, which are known as gilts, and in US government bonds known as treasuries. This is because the Bank of England and the US Fed used their QE money to buy their government bonds. Gilts and treasury prices have soared as a result, taking the rest of the bonds market with them. Now, the situation is not quite so serious in the corporate bonds, high yield bonds and emerging bond markets, but nevertheless, even here, prices are today looking quite stretched. A slump in gilt and treasuries would hit these areas too. The key to what happens next is the state of the UK, US and global economies and how much more QE the US Fed and the Bank of England will do. If the UK and US economies continue to dip in and out of recession, then bonds will continue to look attractive to some investors, even though they are expensive and their rates of return are poor. But if there is any sign of a sustained recovery, or that the central banks are ending their policy of printing money, then bond markets will go into reverse. All in all, it feels like bonds are walking on very thin ice.